Michael Burry has said that we're only halfway through this equity market sell-off in 2022. Now that's pretty shocking given the size of the falls already. So in this video we're going to dig into what he says and why he thinks that's going to happen, and I find myself in the remarkable position where I actually agree with a lot of what he says. So let's look at what Michael Burry said in a bit more detail. If you're not familiar with Michael Burry, this is what he looks like, and he founded his own hedge fund effectively to run his own money in 2000, and it's called Scion Capital. And you can actually track what he buys because the fund is so big using his 13F filings, but he just made some brilliant calls when he went short the market. That means he's making money from falling prices. He did that in 2000 with the dot-com bubble, and he did it again in 2005, leading into the global financial crisis, although he was a bit early to that party, but ultimately it really paid off for him. Now this is the tweet which I'm going to be talking about in this video, where he's saying what's happened to markets already, but also talking about the reasons behind it and why he thinks it's got further to fall. So the initial falls, he says, were due to something called multiple compression. And the second phase of the sell-off, he says, is going to be due to earnings compression. And that, he thinks, could take the markets down as far again. And one thing you should know, if you're not familiar with Michael Burry, is that he's a perma-bear. That means he's always bearish about markets. He seldom has long positions, which he talks about. And if you're a little bit cynical, what you could say is that he wants markets to fall, so he's going to talk markets down, because that would profit his portfolio. Or perhaps what he's saying is what he genuinely believes. Either way, I think what he says is interesting, and it's certainly going to teach us something about markets. If we're halfway through the sell-off, what does that mean? Well, here are the three indices which Burry was discussing. The S&P 500's in a bear market down by just over 20%. The Nasdaq's down by 30%, and Bitcoin is down by a whopping 59%. So if we are halfway through, it's looking like it'll be really ugly in 2022. What I've also shown here are the Federal Reserve policy meetings. In January, they decided to do nothing. In March, they raised rates by 0.25%. But the real turning point, I think, was in May, when they actually raised rates by 0.5%. At this point, it was pretty clear that they'd thrown the idea of a Fed put when they bail out equity markets with rate cuts out of the window, and instead they were focusing almost completely on getting inflation back down to their 2% target. And then a bit before the meeting in June, we learned that they'd actually be increasing rates not just by 0.5%, but by 0.75%. So they were raising rates at an accelerating rate. And markets certainly didn't like that either. So what would this mean for the S&P 500? Well, its maximum for this year was 4,800, and it's fallen by about 1130 index points since then. So if it falls by the same amount again, that would take the total fall for 2022 to something like 50%, which is certainly not unprecedented, but it would be shocking for many people who've simply seen markets trend upwards with a brief interlude during the pandemic. Burry says that the cause of the sell-off so far has been multiple compression. To see what that means, let's look at the price of the S&P since 1950. That's what you can see in blue beside me, and notice how it gradually increases over time. Why does it do that? Well, it's because the earnings or profits of the companies in the S&P 500 have also increased over time by about the same amount. Now, both of those drift upwards over time, roughly in line with each other. So if we divide the price by the earnings, what we get is this. Now, that's the price to earnings multiple, and it snaps back to a typical long-term value, which in the case of the trailing price to earnings ratio, that's the price divided by profits over the previous 12 months, that snaps back to around 17 times. That's the dash red line you can see here. Sometimes it's above that average, sometimes a bit below, depending on whether there's euphoria or gloom in markets, but it always comes back to its long-term average. And if instead of dividing by the trailing 12-month profits, we divide by the forward 12-month profits, which is a forecast, that's called the forward price to earnings ratio. And here it is for the S&P 500 going back to 2012. Notice how it trended upwards gradually over time, then it shot upwards after the pandemic sell-off, which was this very brief dip here, after it went down to a 13 times multiple, but it very quickly went to euphoric levels. This is roughly where it was at the dot-com bubble as well. But then since 2021, we've seen that derating, or the price to earnings compression, as Burry calls it, and that's been responsible for a lot of the falls in equity markets that we've seen, such that right now we're at a multiple of 15.8 times. So what we can do is decompose the price of a stock or a whole index like the S&P 500 into two components. The first one is based on fundamentals, in this case the profits of the companies in the S&P 500, and those are forecast to be $240 over the coming year. And we multiply that by our price to earnings multiple, that's our euphoria indicator, which is 15.8 times right now, and if we multiply the two together, we get 37.85, which is where the S&P 500 was at recently. Now that means that the S&P 500 could come down for two reasons, either due to the multiple compression, which is what we've seen so far, or it could be because of something which we haven't seen so far, which is the fundamentals coming down. Those are the broker forecasts. So the black line you can see here is the value of the S&P 500 going back to 1950, which we saw before. And what I've done is to calculate what the earnings tells us should be the level of the S&P 500, and that's shown in blue. And stacked with that is the amount of euphoria, which is the difference between the two. Now, if we look at the far right in 2022, you can see that euphoria, that joy, very rapidly ebbing out of markets. That's the multiple compression. But notice what usually happens is that the joy doesn't stop there. It very rapidly turns into gloom. That's what happened in 2008, and it happened in 2000 eventually, and sometimes the gloom lasts for a long period of time, as it did in the late 70s and early 80s. So what might cause the next leg of this sell-off, as Burry is suggesting, is that we go from joy into this period of gloom. So not only will the forecast earnings fall, but we could also derate further. Before we move on to talk about the next leg of the sell-off and the reasons for it, let me just quickly mention our membership, which we run on our website, PensionCraft.com, where you get access to lots of goodies, including loads of members-only videos and a chat application called Slack, so you can ask questions anytime you like. If you want to learn more about that, just click on the link beside me and in the description beneath me. What we're going to get next, according to Burry, is earnings compression. Now what you can see here are the actual quarterly earnings for the S&P 500 going back to 2013. They increase fairly steadily, then they accelerate in 2017. There's a brief hiccup due to the pandemic, but then they recover very quickly. And then the forecast earnings, those are what the brokers are producing, that's the red line which you can see here. And you could be forgiven for thinking that there are absolutely no problems ahead. Inflation isn't above 8%, eroding margins, we're not going to get a recession, everything is fine. But everything is not fine. Margins will usually compress when we get very high inflation. Companies have to pay higher prices for their input costs, and that inevitably has an effect on the bottom line. And if we get a recession, that usually affects the top line. People spend less when there's an economic slowdown. So what I think we're seeing at the moment is broker forecasts which are just far too optimistic. And to illustrate that, here are two nice graphs which are shared here by Maverick Bogdan on Twitter. The first one, which is really interesting, is it shows how the broker forecasts for a given year vary through the previous year. So for example, in 2016, they started off very optimistic at around $140, but as news came in about the actual earnings, gradually downgraded to where they finally ended up, which was well below their initial estimate. The same thing happened in 2017. Optimism faded to a less optimistic forecast. 2018 was actually revised upwards halfway through the year, but notice what happens in a bad period. It takes brokers a long time to capitulate to reality and to actually downgrade their earnings forecasts. Then after a big shock, they tend to start pessimistic and gradually get more optimistic. But what we've seen for the forecast for 2022 is just a gradual increase in optimism. And the same is true of the 2023 forecasts. So no signs of earnings downgrades yet due to recession or lower margins and high inflation. Then the next question is, if we do get a recession, what will be the effect on earnings? How much will they fall? Well, here's a nice analysis by JP Morgan, which looks at the last 11 recessions in the US. And they've actually split it into two types of recession, a deep recession and a mild recession, based on how much the S&P earnings fell. Now what you can see at the bottom here is the average and the median fall, which is around 17 or 18%. Remember, that's not what we're seeing right now. We're not seeing any downgrades at all. We're still forecasting pretty strong earnings growth, in fact. If it's a deep recession, we get a 24% fall in earnings, and if it's a mild recession, then minus 9%. So we've seen the multiple compression, we've looked at earnings compression, let's put those two together. And that's what we've got in the grid above me. What I've shown here is the kind of everything's fine value of earnings. That's pretty much where we are right now with the broker forecasts. And that's for $230 profits for 2022. Then we've got the mild recession case, which is $210. And then we've got the deep recession, which is $175 profits. And I've marked that with smiley faces where 230 is optimistic, 210 is kind of intermediate, and then 175 is despair. Then you have to combine that with where the multiples are. How much euphoria will there be in this new scenario at the end of 2022? Ranging from despair, deep despair during the global financial crisis, when we had a multiple of about 8 times, all the way up to the 5-year average recently, which has been pretty euphoric. And that's a multiple of about 19 times. What I think is most likely at best is that we're going to have a 60-year average multiple, which is 15 times, and maybe a mild recession. That would take us down to about 3150 for the S&P 500. And if we convert that into a percentage, that would be a fall of about 18% as of the closing price on July the 1st. If you're a little bit more bearish about what's going to happen to earnings, that would put us at 26.25 if it's a deep recession, and that would be a 31% fall. And if you combine the COVID-19 multiple with bearish earnings, we'd get a fall of about 41%. So what this lets you do is combine your view on earnings with your view about the amount of joy baked into markets, or doom, if you want to look at it another way, for the end of this year. But however you look at it, I think we're very unlikely to have this double joy combination of very strong earnings and high multiples. I think that's simply too optimistic. In conclusion then, if as many people expect we are going to get a US recession combined with high inflation, then that has to reduce US corporate profits. And if we look at broker forecasts right now, that simply isn't priced in. They remain very optimistic. And if we do get an earnings compression as Burry expects, then that would mean further equity market falls, almost certainly. What does this mean for us as investors? Well, it's good news in a way because it means any new money that we put into markets will be bought at a lower price. It's a bargain. And for our long-term returns, that can only be a good thing. If you are going to invest for the shorter term, then it's a worry. And that means a horizon of 5 years or less, say, with your money. But if you are someone in the process of building up your life savings, which many people are, then this can only be an opportunity to buy at a discounted price. Remember that this is an equity sale, not an opportunity to sell your equity. Now, Q1 earnings has been pretty good this year. It was over 10% year-on-year growth. But when a company did guide downwards on future profits, it was certainly punished. We saw that with Target. We saw it with Walmart, we saw it with Amazon. So maybe that is the start of this downward compression in earnings. And I think it's unlikely we wouldn't get a downward compression in multiples as well if inflation stays high and we get a US recession. So let's hope that doesn't happen. But if it does, remember it's a buying opportunity. It's not a reason to sell. Now, also don't forget our offer. You can go to PensionCraft.com to join our membership and learn more about investing. There'll be a link about that beside me and in the description beneath me. And as always, thank you for listening.